Hello, everyone. My name is Brooke Hart, president of Presilium Private Wealth, and today I wanted to talk to you about an important, albeit oftentimes confusing topic, long-term incentives. So the great news is you've just received the latest update about your long-term incentives. You and your company had an excellent year, and this bonus reflects it. Or you've worked hard to climb the ranks and are now, for the first time, going to receive long-term incentives. Now comes the hard part. What do you do with your restricted stock units, or RSUs, as they're known? Though each company is slightly different, most often we see a one-time annual vest with each tranche of RSUs vesting over a 3 or 4 year period. Nothing you probably didn't already know. However, when it comes to the ownership and vesting of these bonuses, there are a few key considerations that can really make for a much less stressful tax day come the following April, as well as a much more comfortable retirement down the line. Now, to start, the number of shares that vest multiplied by the share price on that day is equivalent to the amount of additional ordinary income that you will have to report on your taxes that year. This means that between your base salary, your cash bonus, and your vested RSUs, you could be in a significantly higher tax bracket than you had originally planned for or ordinarily used to, and you need to plan accordingly. The default federal tax withholding is 22%. This means that the custodian of your stock plan, like a Fidelity, a Morgan Stanley, etc., will withhold this designated percent of taxes in the form of your newly vested shares. However, this default percentage is almost never enough withholding, leaving you with a bigger than expected tax bill the following spring. But the nice part is, with enough pre-planning, is that most companies allow you to adjust this either before or at the time of vesting. So you should absolutely consult with your tax advisor prior to your vesting period to make sure that you have an appropriate percentage of withholding in place ahead of your vest date. If you have to pay the taxes regardless, it is certainly a much better feeling to withhold them ahead of time than to be surprised the following spring with a large tax bill. Now that we have the ordinary income aspect of your RSUs, we move on to the capital gains aspect. Once your RSUs vest, an appropriate amount of taxes are withheld, the remaining shares are yours. They behave as if you had purchased the shares on the open market yourself. So this means that if you sell the shares at any time during that first year, it will show up as a short-term gain or loss, depending on how the share price has moved. And as soon as you hold the shares for a year and a day, they shift to now being taxed as a long-term gain or loss. When it comes to strategy and diversification, this is an important consideration. Too often, we see longtime employees who maintain a lot of pride and belief in their company and the work that they do build up a large position in their company stock because of this. At a certain point, it is likely that you will need to sell. You're either going to need cash on hand or you'll be heading into retirement and want to sell just to simply achieve more diversification. However, you've now built up a position in your company stock that is 20, 30, 50% of your overall net worth. Not only can this pose a massive risk to the success of your retirement plan, but this can also pose a massive problem for your tax bill. If, for example, each time that your RSUs vest, you immediately sell and invest the proceeds in a properly diversified portfolio, you have a much greater opportunity to buy and sell and tax loss harvest in a way that minimizes the tax impact on your portfolio over time. If, on the other hand, you hold on to your RSUs each and every year, and hopefully they at least do well, you are now stuck between a rock and a hard place when it comes to generating income from your portfolio. If you were to sell, you must now think about selling an even larger portion of your holdings due to the fact that you will also owe a fair amount in capital gains because of the growth of your company stock over the many, many years which you have owned it. Not to mention, in terms of overall exposure, this company in which you maintain such a large percentage of your overall net worth also happens to pay your salary, your bonuses, provides your 401k match, possibly funds your pension plan, your health benefits, and so on, ultimately leaving you one failed trial or one bad piece of legislation or news away from being unable to approach retirement in a much more comfortable manner. Navigating your long-term incentives can be incredibly confusing. It can be incredibly time intensive, but with a sound, disciplined approach prepared ahead of time, you can take a few steps in the right direction towards a lower tax bill, as well as a much more certain retirement outcome.